Welcome to this introductory lesson of financial management. And in this class, I want to address the meaning and scope of financial management. Financial management is an extension of the discipline of management. And in management, the key functions that managers carry out include planning, organizing, directing, and controlling. Now, when we bring those into finance, then it is what we refer to as financial management. And therefore, we can define financial management as the planning, organizing, directing, and controlling of the organization's financial resources to ensure stability, profitability, and long-term growth. Financial management addresses areas to do with investments, financing, dividends, and working capital management with the aim of maximizing the shareholder value while maintaining liquidity and compliance. I will be addressing later on the reason why maintaining liquidity and compliance are very, very important aspects that a finance manager must consider when they are doing financial management. Now, financial management is interdisciplinary. It borrows heavily from three major disciplines. One of them is economics, the other one is mathematics, and the last one is accounting. Those three disciplines give us the basis for financial management. Economics gives the broad principles that are applied in finance, mathematics gives the methods, and accounting gives the historical data. And finance will apply the principles of economics using mathematical methods on data generated from accounting to apply and optimally use the scarce resources of a business organization. Financial management will involve raising and allocating the scarce resources of a business organization to the most productive use so as to achieve the objectives of the business. Now, on a day-to-day basis, what does financial management involve? What are the key decision areas that the finance manager makes on a day-to-day basis? The finance manager will make four major decisions. I'll begin from the first one, what we call the financing or capital structure decision. Capital structure is the combination between debt and equity that is used to finance the affairs of a business. The question that the finance manager asks himself or herself in this case is, where shall we raise money from to finance our investments? The money may be required in the short term, medium term, and long term, although in this case we focus ourselves largely to the long-term source of finance. Those are the ones which constitute what we call the capital structure of a business. So the finance manager will therefore examine the various sources of long-term finance. Debt, which can come from many sources like debentures or bonds, and equity, which can be internal equity, which we call retained earnings, or external equity, which is raised from issue of ordinary shares. So the finance manager then has to decide which is the best combination between debt and equity that we will use to finance the affairs of the firm. The goal in this case is for us to employ a source of funds that gives us what we call the lowest cost to the business. One of the topics that we will be discussing in this course is what you call the cost of capital. And one thing that you need to know very clearly is that capital has a cost. So the finance manager then has to ask himself, of these various options that are available, which one is the cheapest source of funds for the business? The second decision is what we call the capital budgeting decision. And the capital budgeting has to do with selection of the best long-term investments. The other name for this is the investment decision. And the finance manager has to ask himself or herself, which are those investments that are giving us more benefits than the costs that we will expend for us to get those investments. And you realize that a business will have various investment options available, but the money available to be invested is in most cases limited. So we must select the best investments for us to commit our money into. And the whole essence of capital budgeting is evaluation of investments in terms of variables like size, risk, and return associated with those investments. This is, of course, is to ensure that the funds we raised are being committed into the most viable investment opportunities to give the sufficient return to those ones who provide the funds to the business. Then the third decision is what we call working capital management. The other name we give this is liquidity management or the liquidity decision. And working capital broadly is the current assets and the current liabilities of the business. And the finance manager has to ensure that the firm has adequate current assets to pay off the current liabilities. The current liabilities are the day-to-day obligations that the business has to pay. The business, for example, has to pay utilities, it has to pay rent, it has to pay suppliers. And to pay all those things, we normally raise money from current assets. So we go pay this from our cash in hand and the cash at the bank, from our collections from debtors who pay their obligations, from our sales, and such like. So we use current assets to settle the current liabilities. And it's important for you to maintain an optimal level of current assets so that you are able to settle current liabilities as they arise. The problem of inability to pay off current liabilities is that you will soon run out of suppliers. For example, if you can't pay suppliers, at one point they will stop supplying. If you cannot pay salaries on time, at one point you'll have staff who will be demotivated, who might even help themselves from your cash till. They will not put in their best efforts. If you cannot pay utilities, at one point the utility providers, for example, the power providers will be unable to supply. You'll be cut off. And that is the reason why management of working capital is central to an organization. And that is one of the key concerns of financial management. And the last concern of financial management is the distribution decision, which we again call the dividend decision. And this has to do with what do we do with our earnings at the very end of the financial year. So once the business has made profits, we've paid our tax obligations, we must make a decision, what do we do with the remainder? That decision is between what we call retention and distribution. A portion of the earnings are normally retained in the business to strengthen its financial position. In fact, one of the cheapest and most convenient source of capital for a business is retained earnings. But again, we have shareholders who've committed their money into the business. They are expecting to earn a dividend. So we must make a choice between dividend distribution and retention. And how much do we retain and how much do we distribute? That is the whole concern of the distribution decision, which is equally known as the dividend decision. So in summary, financial management has to do with four major areas that I am presenting in this matrix. What we call the financing or capital structure decision, which deals with the determination of where do we raise money from to finance our activities as a business. This is meant to ensure we raise capital at the lowest cost. The second decision is what we call the capital budgeting decision, which has to do with evaluation of the various investments available in terms of size, risk, and return, so that we select the most viable long-term investment opportunities that are beneficial to the business. The third decision is working capital management, which is concerned with balancing the current assets and the current liabilities to ensure the business has adequate operational liquidity and day-to-day funding. And the last one is the distribution decision, which has to do with allocating and distributing the net earnings, allocating and between distribution and retention of the net earnings of the business. Those are the four major decision areas of financial management.